Hi traders, welcome to this last edition of 2024 of Expert Market Analysis, brought to you by Errante. This is generally a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. Whilst I'll just let you have a look at the couple of disclaimers that I need to show you, I'll just run through some of the key objectives of the webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories and narratives can be long-term fundamentals or short-term themes that increase or decrease in importance over time. One of our goals of the webinar is to break down all the market jargon and complexities that we read about. So if you do have any questions, please do ask them along the way, and hopefully we can answer those as we go, or at least at the end of the webinar. Okay, it's Wednesday the 18th of December, just after 11 a.m. in London. So let's get to it. We'll follow the main we'll follow the usual format actually. So we'll just check out how markets are trading currently. We'll just highlight a couple of key points from the last week or so before then getting into all the main risk events that we've seen over the last week. That includes US CPI data and a bunch of central bank meetings, which of course we get this week as well. We've had the ECB, the RBA, and the Bank of Canada. So we'll just run through those and the associated currencies before then getting into this week's main events. The Fed, of course, later on today. We'll have a look at the Bank of England report meeting, as well as the Bank of Japan meeting, and we've had already some important UK data as well to assess. So we'll check out everything central bank wise, and of course all the associated currencies and markets as well. Firstly, just markets generally, APAC stocks eventually traded mixed, with sentiment somewhat cautious, of course, following the negative lead from Wall Street, mixed lead really. US assets traded sideways overnight as the focus is turning, of course, to the FOMC announcement and Chair Powell's press conference. Bitcoin did see heavy losses overnight. Actually, prices retreated under 104,000. Despite a lack of news flow, really. We had merger talk in Japan between Honda and Nissan. Merger talks amid EV competition, and European equity futures pretty much flat, pretty subdued open really, to be expected ahead of the big risk event obviously later on today in the form of the FOMC. Just a couple of points to note, and I'll just pull up a couple of charts first of all. We just got the S&P 500 chart here. First of all, we had actually record highs. We've seen record highs in some of the key mega cap tech titans. We've seen that in Apple, we've seen it in Alphabet, we've seen it in Tesla, and in fact Tesla has risen 9 out of 10 of the last trading sessions to record highs, those three stocks. Alphabet really, that rose actually over 10% last week on 2 days of back-to-back news. Firstly, the company introduced a new Willow chip, marking a milestone in quantum computing. And despite really that real world sort of impact being some years away, investors are really happy to see the progress. And then also midweek last week, we had Alphabet announcing its Gemini 2.0 model, new enhancement of its AI offering, really again spurring the stock price on. I also think we had some a Trump nominee, antitrust nominee, which is perceived to be lighter really than what we've seen previously, so it may be a good thing for some of the mega cap tech stocks. Interesting divergence in a way between the tech stocks really, consumer discretionary, which is Tesla obviously leading the way, and then also for example the Dow, and more defensive stocks, which is struggling a lot. And if you just see the S&P, really not too much to note here, just below the all-time highs, and just looks like bullish consolidation before a move higher. Of course, everybody seems to be very long US stocks, US exceptionalism, due to obviously the resilience we've seen in the US economy over the last few months and year really, but then of course as well President Trump incoming administration and potentially pro-growth, pro-inflationary policies as well, which is expected to push stocks even higher. With NASDAQ, we've seen that, and you can just see 22,133 is the all-time high now, and we just paused with the doji, pretty much expected really coming into the big risk event, as we say. But you just contrast that with 9 consecutive days of selling in the Dow Jones. We haven't seen that in 45 years. And really no specific news driving this sort of divergence really between tech stocks, consumer discretionary going higher, and as I say, some of the defensives just struggling at the moment and forcing the Dow to move lower. You can just see we're now at the halfway point of this sort of November push higher, just before the election really, up to the all-time highs. The halfway points at 43,360, and then you've got this swing low from mid-November at 42,938. Yeah, really interesting move, and not much news on to cause it really. One other point we want to get across is China's bold policy shift really from last week. Chinese authorities kind of surprised the markets by signaling a shift in its monetary policy stance to moderately loose. That's the first change in 14 years. 1-4, and really indicates the economic challenges facing the country are recognized now as being quite severe. The measures possibly include a sizable central bank purchase of government bonds, and then coupled with aggressive cuts in interest rates and reductions in banks' required reserves. Stimulus could also be key, of course, for China to offset any Trump tariffs in 2025, of course, and really the move shows really quite strong determination in its quest to avoid a sharp economic slowdown. So that's really something to watch out for. Both monetary and fiscal policies, levers really moving in China, as I say, to offset potentially those tariffs, but also because growth has been slowing this year below 5%, which is acceptable and on target because they've slightly changed that objective to around 5%. I think we're 4.8% this year, but still potentially there are concerns going forward into the new year, and hence this change in both monetary and fiscal policy in China, and really something to watch going forward. If we just let's get now to the main event from last week, which was US inflation data. That came in bang in line with consensus, actually leads us quite nicely onto the Fed, of course, today. Monthly growth of 0.3% for both the headline and the core, resulted in annual readings of 2.7% for the headline, from 2.6 and 3.3% in the core, which was stable actually. Key point really that it's the 4th consecutive 0.3 month-on-month print. The annual inflation rate has stalled just above 3% for the past 3 months, while the 3-month annualized rate has actually picked up quite markedly since the summer. Details really show housing showing a little more benign, with owner equivalents, rent and primary rents coming in, well, quite a pleasing 0.2%. But overall, we still need prints of 0.17%, just below 0.2% month on month in the core to hit and get back to the Fed's target of 2%. We're not getting that yet, and we're getting sticky inflation over the last few months, which is or will be an impact for the Fed going forward. Upside pressure, just to note, largely came from vehicle prices. New vehicles rising 0.6, used vehicles jumping 2% after a 2.7% increase in October. Of course, we ultimately this is pointing to kind of a stalling disinflation process, and that will be strengthened potentially by, of course, Trump's inauguration and then first official policy moves, which are widely seen as being inflationary. Flip side to this, of course, is the job market slightly cooling, and that obviously brings into play the 25 basis point cut that we'll very likely see later on today. That's the inflation data. Just got a chart as well, just showing that uptick now in core CPI. The PC number, which is the Fed's favored inflation gauge, has been ticking around 0.2% or so, and obviously the Fed are more comfortable with that, but just other indicators showing a stalling disinflation process, as I say. Moving on from US CPI to the ECB meeting last week. They did deliver, of course, a 25 basis point cut, took the deposit rate to 3%. That's the lowest since March of last year. Lagarde, generally pretty dovish. She noted that a 50 basis point cut was discussed, but it failed to gain traction. This decision really reflects kind of a compromise between growth and inflation worries. Kind of gut feeling versus this more model-based approach, which the ECB has been trying to use, and then obviously the doves against the hawks. At the same time, the ECB dropped the reference to keeping interest rates sufficiently restrictive for as long as needed, and that really means it's keeping the door wide open now for more rate cuts to come. After the meeting and also Lagarde's press conference, the inevitable Reuters sources noted that a handful of policymakers were initially in favor of a bigger 50 basis point cut, and some argued that the ECB is overestimating growth, which could be below 1% next year under Trump tariffs. So yes, no declaration on victory on inflation, but Lagarde did note the direction of travel is clear and signaling really further rate cuts to come. Markets, they expect around 125 basis points, 120 basis points of rate cuts now from the ECB next year, and that compares with, at the moment anyway, around 70 basis points, 75 basis points of cuts from the Fed, and even actually less now from the Bank of England. So that was the ECB in a nutshell. If we just go to euro dollar, you can just see we've struggled obviously since printing above 112 in the autumn. We got down to 103.31, that spike low from November, and we're just now hovering around this long-term low 104.48, which is that low from October last year. Just looks like bearish consolidation before we do move through that level, but it is a big level, as you can see. So strong support there, 104.48. Then obviously the spike low 103.31. Many economists really predicting that we get to parity in euro dollar sometime next year, essentially owing to Trump's tariffs and just general stagnation and political chaos really in the eurozone, with no real functioning government in France, and German elections next year as well, although possibly, and we've seen data, actually the ZEW German business survey data possibly picking up, or did pick up actually this week, just possibly on the hope of some sort of resolution to some of the political issues that we have been having, certainly in Germany, and going forward for next year. That's the level in euro dollar. We also had, of course, the RBA meeting from last week and the Bank of Canada. The RBA kept rates unchanged, actually, as expected, at 4.35%. Markets pricing in very small probability of a rate cut. Governor Bullock, though, noted that the RBA did not even discuss cutting rates last week, but the forward guidance was more dovish than before, notably more dovish, really. It delivered no new economic forecast, but still confirmed that the board had gained more confidence on inflation returning to target. So again, disinflation process on the way, and seeing forward guidance from the RBA slightly more dovish than expected. They also acknowledged, actually, the board, that the recent downside surprise in Q3 GDP and also that Bullock did not write off the possibility of a cut at the next meeting in February. That pushed Aussie dollar down near to 64, markets pricing in around sort of 50-60% chance of a first cut in February. We did get stronger employment data out of Australia a day later, actually last week, so that pushed back the first rate cut sort of to April. But yes, it's certainly on the horizon, potentially in the new year, from the RBA. Aussie, of course, has struggled since printing that high in the start of October at 69.42. You can just see we've got now below that spiked low from August at 63.47. So if I just pull it back now, we've got a lot of sort of big zone of support around 63 or so. You can see here from October last year. Before then, this very important long-term low from October 2022 at 61.69. So first initial support now around where we are currently. If we do break down further, then potentially 61.69 comes into view. Very protracted bear trend though, slightly getting into oversold territory possibly, but only on the daily. You can see on the weekly, yeah, it looks as though yeah, if we can get through this support zone, then 61.69 is a target for the bears in the Aussie. Also, we had the Bank of Canada meeting, really not pretty for the loonie either at the moment. But the Bank of Canada, they cut rates by 50 basis points. Interesting. Well, that took the target rate to 3.25% from a peak of 5%. And that now matches the top end of the Bank of Canada's neutral rate estimate. But the bank did remove language from the statement about it being reasonable to expect further rate cuts if the economy evolves in line with forecast. Instead, the bank will evaluate the need for further rate cuts one decision at a time, with decisions guided by incoming information and their assessment of the implications for the inflation outlook. That kind of suggests, did suggest a more gradual approach by the BOC, as the central bank has basically removed restrictiveness from the policy. Looking ahead then to next year, money markets, they kind of imply around 60 basis points of easing still, so slightly less than around the 70 basis point mark before the Bank of Canada meeting last week. Signals a possible slower path ahead in rate cuts. But of course, Trump's tariffs have really put in a huge, big turn of uncertainty potentially into the Canadian economy. And of course, that has caused political ructions as well this week, with the resignation of the finance minister disagreeing with the government about how they should handle the tariffs, and that has really pushed dollar CAD to long-term multi-year highs. If we just look at dollar CAD now, you can just see consecutive weeks of gains by the dollar, and you can just see now we're back to levels seen in March 2020, around sort of 143.23, and there are just multiple highs here. So one's at 143.49, and then you've got the spike highs from the pandemic, 145.60 above. We are overbought now on the daily RSI and the weekly RSI. You can see there, so potentially warns of a correction, but at the moment, political chaos as well as obviously a dovish central bank, really, with still more rate cuts to come, even though, as I said, we're still around the top end of that neutral rate, and we're obviously markets still pricing in around 60 basis points of cuts for next year. Okay, this week, we have had PMI data actually out of the Eurozone, UK and the US, just worth highlighting. And whilst I pull up, well, we've looked at Eurodollar already, of course, but the PMI data, interesting. Well, it kind of rose more than expected in December, recovering some of the large decline in November for the Eurozone. Composite rose actually to 51.4 from 49.5. So above 50, which is important, expansion contraction territory, that is. Manufacturing stood unchanged, while services actually rose more than expected, and again rose above 50. It's really services which continues to make up for the declining activity in industry. The average composite PMI is lower than in Q3, so the data really supports the view, though, of a contraction in the economy in Q4, with GDP potentially at negative 0.1% Q on Q, driven by manufacturing. Services prices, just in detail, rose to the highest level since August, showing there is some still modest pressure on prices, whereas the employment subcomponent that declined in December, showing the labour market is gradually cooling and supports expectations of slightly probably higher unemployment in the coming year. That's the Eurozone. UK PMIs mirrored those really from the euro area, so stronger services and a decline in manufacturing. Service sector again continues to hold up the economy with an increase in private sector outputs offsetting that decline in manufacturing production. Price indices, again in detail, were higher across the board, indicating really that continued stickiness we're seeing. And that is a concern for the Bank of England. On the flip side, the employment indicator came in weak, and that points to accelerated cooling in the labour market. Finally, the US, well, the PMIs were a mixed picture, really. Manufacturing plunging below 50, yet services accelerated more than expected to 58.5. Yep, services PMI, sorry, probably the most important driver of current inflation. Yes, but a mixed picture in the PMIs in the US. Okay, let's get to this week's main events, of course. Fed meeting first up. And you can see the graphic here. Hopefully these are helpful to you guys. Obviously the Fed has cut 75 basis points over the past two FOMC meetings, fully expected to cut another 25 basis points in a few hours time. Inflation data has not been making, as we just pointed out, really any real progress towards target over the past few months. But then, of course, we have to consider the Fed's dual mandate, which means it pays close attention to what's happening in the jobs market. There are signs of cooling with payrolls growth slowing and unemployment shifting a touch higher, really, and that justifies then the policy move, or the Fed moving policy closer towards neutral. But it is clear, probably pretty clear, that the pace of rate cuts will slow at the start of 2025 at least. That is, of course, unless inflation starts to make more rapid progress towards the 2% target, or the jobs market deteriorates markedly. And at the moment, that is not expected to materialize. Key will be the dot plot. Again, we had one in September. We have one at this meeting as well. The Fed likely to signal the prospect of 3 25 basis point cuts in 2025 in its forecast update. That is down then from 4 25 basis point cuts it suggested at the September median dot plot and the projections. We will also see growth and inflation forecasts probably revised higher, with the latter actually rising to 2.8% from 2.6% in September. It all potentially means then that the Fed will pause on rates in January amid, of course, ongoing concerns now about rising inflation risks and, of course, Trump's incoming policies. At the moment, markets agree with that idea, really. They just see around a 15% chance to think of a cut in January, so an 85% chance of a pause in January. And then at the moment, I think it's around a 50-50 bet on a March rate cut. So that can certainly flip one way or the other when we hear from the Fed, their forecast, the economic projections, the dot plot, and of course Fed Chair Powell during the press conference. Very, very likely he doesn't really say very much at all about Trump and certainly what happens in January and going forward. And we'll want to see the new administration's policies as well as, of course, data going forward. There may be some focus, just to point out, on the longer run Fed funds rate, which is currently 2.875%. That may give us clues, of course, about how much the Fed could cut rates ahead. Yeah, the 25 basis point takes the target policy band, as you can see there, to 4.25% to 4.5%, so still well in restrictive territory. As for the market reaction, just pull up a couple of charts then. First of all, the DXY chart. Hawkish rate cut is really now probably what is expected. So we have to really get that validation of that really to be dollar supportive. You can just see we're tracking sideways over the last few days, so waiting for this big risk event. And really, yeah, a confirmation of this change and a more cautious approach to rate cuts going forward then could spark a rally in the dollar, of course. Although we do note actually there is potential for a short-term pullback due to typical year-end seasonality, selling of the dollar, and also there is very stretched positioning with big long positions in the dollar at the moment. That said, any dips potentially could be seen as buying opportunities, of course, with, as we mentioned, Trump's administration and potential pro-dollar policies coming in, such as heightened tariff talk, of course, and that then could potentially support the dollar going forward. And then this certainly looks like just bullish consolidation before a break higher, 107.34, that key long-term high, with the spike high from November at 108.07. But yeah, looks like just a bull flag before we break higher at the moment. Otherwise, equity market reactions then, a signal of fewer cuts, of course, may cause renewed volatility in stocks, with a hawkish tone really potentially putting downward pressure on equity valuations, especially growth stocks, because they're more sensitive to higher rates. And that could mean then investors sort of rotating into more defensive sectors, which like utilities and consumer staples, which could help the Dow, of course, in its record losing streak that we've just pointed out. Okay, next we'll just move on to the other central bank meetings from or due to happen this week. We do have the Bank of England meeting, of course. We've gone through some of the key bits of data already. We had labour market data, which reflected really a larger than expected jump in wage growth. So average weekly earnings jumped to 5.2%, while the ex-bonus number jumped to 5.2% as well, from 4.9. Unemployment unchanged at 4.3, kind of immaterial because of the reliability issues there. But higher wage growth was the key number on Tuesday, the first pickup in a year, and that really tempered prospects for Bank of England rate cuts in 2025, with the first full 25 basis point ease, or the next ease, really priced out of the March meeting and pushed back to May now. We did get headline or CPI data out earlier this morning as well out of the UK. The headline rose as expected to 2.6 and 2.3, mainly down to unflattering base effects. And then the core rose to 3.5% from 3.3. That is more noticeably than the Bank of England had forecast, in part really because of a slight uptick in services inflation. That is the key input for the Bank of England. That printed at 5% for a second straight month, and it's a touch higher than the Bank of England's most recent forecast, and is expected to continue at around 5% through the next few months, actually through the winter. Stickiness is kind of down to some of the components that the MPC is less bothered about, so travel and rents, but still, it's still way too high for near-term rate cuts. That leads us into, of course, the meeting Tomorrow, the Bank of England meeting, they'll keep rates at 4.75%, with an 8-to-1 vote split expected, with Dingra the lone dissenter. The MPC kind of seems content with cutting rates at every other meeting, and there's little in the recent data that likely changes that assessment. For now, we've just run through most of that data actually, and we get retail sales on Friday. Of course, the Bank of England, they cut rates in November. Another cut is then, well, possible in February, but at the moment, money markets have pushed that the next rate cut out further. We will get fresh forecasts and a monetary policy report in February, don't forget. But at the moment, inflation is sticky. Services inflation, wage growth, sticky as well and elevated. And of course, we do have, well, the PMI is still pointing to expansion. If we just look at cable, you can just see, yeah, it looked as though we were selling off after some consolidation and a failure really to break really conclusively above that downtrend line from the highs in late September above 134. So we broke down the end of last week and down through the 21-day moving average at 126.74, but we just picked up again with 3 days of buying really on the back of that data and the Bank of England rate cuts being pushed out. You can see we're now at the 61.8 fib retracement level of this move from the April lows up to the September highs. 61.8 is at 127.29, so we're back to that now. Interesting whether we can get through that, and then probably last week's high at 128.11. Before then, the halfway point is at 128.62. That would really stop this long-term downtrend. Otherwise, potentially, yeah, support just above 126 before then, a minor fib level around 125.37, and then the recent low is at 124.86. Finally, we'll look at the Bank of Japan meeting. That's overnight tonight, UK time at least. Latest sources suggest the BOJ is really leaning towards keeping rates steady. There is no consensus within the bank on the final decision. Some believe conditions have been met for a December hike, but really there's no consensus. The latest Reuters poll suggests the bank holds rates at 0.25% tomorrow, and then a vast majority of economists say the central bank will hike by 25 basis points to half a basis point, or 0.5% by the end of March 2025. Governor Ueda had telegraphed actually recently that a hike is on the horizon, but he remains non-committal about the timing. And then, as I said, recent sources suggested the Bank of Japan reportedly sees, well, little cost in waiting for the next hike. But then we've had other sources saying that they may delay it until the new year and more data is available. If I just show you finally the dollar yen chart, you can see here, obviously we just pushed up really. We've got the halfway point, we've still got that in here of this move lower. The summer move down, the halfway point is at 150.76. We've got this previous line from previous intervention, that big dotted line, and then we've got a couple of fib levels. The next one, which we're just trading around at the moment, is a 61.8 of this sell-off from the summer. That's at 153.40. So we're just hanging around that. Otherwise, if we can break above that, then you've got the high from mid-November at 156.74. Otherwise, if we roll over, we've got the 21-day moving average at 152.23. And then, as I say, the halfway point is at 150.76. I did show you the Bank of England graphic there. I think we'll wrap it up there, but we've covered a lot in a very short space of time. A lot going on still for this week. Before then, we wind down for Christmas. And then our next webinar is in the new year in 2025. Thank you so much for listening in and tuning in all year. Really do appreciate it. And we wish you a very merry festive period and season's greetings. And we will speak to you in the new year. Okay, take care.